Hey, what's up? It's Ben here. If you're watching this, you're gonna have to pay taxes. That guy right there has to pay taxes, and the guy back there is gonna have to pay taxes unless they're dead. Unfortunately, every year we have to do our taxes and see if we have to pay more or get a refund. And those for you who are fortunate enough to make passive income, good job for you. You deserved it. And that's what probably brought you here, to get a basic understanding of passive income tax rate that deals with capital gains. This will be something simple since anything outside of a W-2 is going to be complicated and messy when everyone's situation is different. So don't be too stressed out about it. But full disclosure here, again, I'm not a CPA, I'm just a random guy on YouTube. Please do consult with your CPA if you have any questions about your taxes. This is in the United States, so if you're watching this outside of the United States, all of this probably won't even apply to you. So there are different types of passive income, and it could be any income you earn from dealing with stocks to dealing with real estate. But the main focus here is capital gains, since this is something where I believe it's easier for most people to understand and grasp. But first, we need to understand what a capital gain is. A capital gain is the profit that you earn when you sell an asset or investment. For example, let's say you bought a house for $100,000 and you sell it for $130,000. The $30,000 would be your profit, or also known as capital gain. And under capital gains, there are two other categories that you will need to know, and they are short-term capital gains and long-term capital gains. Any investments that are a year or less will fall under short-term capital gains and to be taxed at their ordinary income tax. And any investments over a year will fall under long-term capital gains and is normally taxed at a lower tax rate than their ordinary income tax. So technically speaking, if you held your investments longer than a year, you'll get a better tax rate and pay less on taxes, or in some cases, no taxes at all. Now, depending on your filing status, your tax rate might change because someone who is single filing is totally different from someone who is married filing jointly. First, let's dive into the chart and check out the tax rate table for your short-term capital gains that's taxed at your ordinary income. So right off the bat, you see that there's 7 tax rates or tax brackets, however you want to call them, then followed by a bunch of numbers. Don't worry, this will all make sense later. The number in parentheses are just the numbers being used to file for 2020. But we're not going to look at that. Instead, this example we will be looking at is for 2019 filing. So let's say that your filing status is single for 2019. And during that time, you did the right thing and invested your hard-earned money in the stock market and bought some stocks at a really good deal. It was like a Black Friday or something, and you see that this stock price continuously slashed the price and you were lucky enough to buy it at a dip. Then a few months later, the stock price skyrocketed and you made $15,000. Now, since you only made $15,000, you're going to be taxed on the lower end of the tax bracket, which will be 10 and 12%. A common mistake that people make is that they see $15,000 belonging to the 12% category and they just conclude that the whole $15,000 is taxed at 12%, which is wrong. The right way is this. The first $9,700 is taxed at 10%, and whatever is left will be pushed to the 12% tax rate and be taxed at 12%. In this case, it's the remaining $5,300, and if you were to do some quick math, you'll find out that your total tax is $1,606. Now, what if we use that same example but held our investments a little longer than a year, and assuming you're still at a lower end of the tax bracket? We will have a chart like this with only 3 rates, 0%, 15%, and 20% based off of your income bracket. Your $15,000 will now fall under the 0% tax rate. And yes, for reals, it won't be taxed. But if your gains are higher than $39,375, then the remaining will be subject to a 15% tax rate. And then a 20% tax rate if your remaining gains are over $434,550. See, now just thinking about it, investing in something long-term isn't a bad idea, right? If you're just starting out and made a couple of thousands of dollars and you held it for over a year and you think that you had enough, you can essentially just walk away tax-free and start investing in other ventures to make even more money. I'm just saying. This is just the tip of the iceberg when it comes to understanding the passive income tax rate regarding capital gains, and it's easier to understand when your investment is simple. When you start getting into depreciation and deductions, things can get a little tricky. I hope this scrubs the surface for you to get a basic understanding of passive income tax rates. If you're interested in my videos and you want more of me, feel free to tap the like button and maybe consider subscribing as I talk more about real estate, finance, credit cards, and other money related topics. And I'll see you next time.